that we have between among all the regulators, there is something called the early warning group. It has been discussed. We have put forth our viewpoints there. SEBI has taken note of our viewpoints. SEBI has made its own analysis, and any further steps based on the discussion paper and the inputs they get, SEBI will take appropriate action. So, and with regard to the bank deposits, and I think DG has already explained. You see, what the thrust of all that I am saying is that the mismatch or the divergence between bank deposits and bank credit growth, the divergence will create, may create, let me put it this way, may create asset liability or liquidity issues, liquidity management issues. So I'm only flagging this issue that because of this divergence in growth of deposits vis-a-vis growth of credit, it can potentially result in a liquidity management issue which the banks have to deal with. I'm not by any chance suggesting that people should more deposits in the banks, not go for equity market. It is left to the people to decide. It's left for the investor, it is left for the saver to decide where he wants to put the money. All that I am saying is that the banks need to focus on this, mindful of this, because potentially it can create some structural challenges with regard to liquidity management. And one way of dealing with this situation is that the banks have the potential, the huge network of their branches, which they need to capitalize and raise their deposit levels if they have to, if they are proposing to also sustain and support their credit growth. So it is more in the context of a structural challenge that may come up with regard to liquidity management.
थैंक यू सर। अब मैं श्री अनुराग शाह ईटी नाउ स्वदेश से आग्रह करूंगा कि वो अपना प्रश्न पूछें।
धन्यवाद सर सवाल पूछने का मौका देने के लिए। सर, जिस तरह से आपने डिपॉजिट को लेके कहा कि बैंकों को अपना नेटवर्क का इस्तेमाल करना चाहिए, इनोवेटिव प्रोडक्ट करने चाहिए, तो उसमें हमने देखा है कि कुछ बैंक है, मुंबई का एक उदाहरण लूंगा, एक बैंक ने पूरे मुंबई के अंदर बैनर पोस्टर लगाए हैं कि राज्य सरकार की एक स्कीम है, उसके अंतर्गत जीरो बैलेंस आप अकाउंट खुलाइए, हम बड़ी संख्या में अकाउंट खुल रहे हैं। तो यही सब जो अकाउंट होते हैं जो गरीब तबके के लोग खुला देते हैं और बाद में चल के म्यूल अकाउंट या फिर जो साइबर फ्रॉड्स के अंदर इस्तेमाल होते हैं। और ये भी अब देखने को आ रहा है कि साइबर फ्रॉड्स में सर एक अकाउंट से दूसरे अकाउंट, तीसरे अकाउंट की सबकी केवाईसी है, लेकिन फिर भी जिस वो विक्टिम होता है उसको रिकवरी नहीं हो पाती है क्योंकि आइडेंटिटी स्टेब्लिश नहीं होती है। तो सर, जब इनोवेटिव प्रोडक्ट्स की तरफ जाएंगे, आउट ऑफ द वे जाएंगे, तो उस पर भी आरबीआई अपनी नजर बना रहा है।
इसी मैं किसी को आउट ऑफ द वे जाने के लिए नहीं बोल रहा हूँ। बैंकिंग सिस्टम का एक रेगुलेटरी पैरामीटर्स है, रेगुलेटरी पैरामीटर्स के अंदर जो पॉसिबल है बैंक सिर्फ वही करेंगे। आउट ऑफ द वे किसी को जाने के लिए हम इशारा नहीं दे रहे हैं और बैंक्स भी ऐसे नहीं कर रहे हैं, नहीं करेंगे। और जहां तक डिपॉजिट मोबिलाइजेशन है, इंडिविजुअल जो केस आप कह रहे हैं उसके बारे में मैं कुछ कहना नहीं चाहता हूं, क्योंकि आपको पता है इंडिविजुअल केसेस के बारे में हम कमेंट नहीं करते हैं। बैंकों का जो गवर्नेंस स्टैंडर्ड है, रिस्क मैनेजमेंट स्टैंडर्ड है, उसमें काफी इंप्रूवमेंट हुआ है पिछले कई सालों में। तो जो नए प्रोडक्ट्स हो या जो नए ड्राइव हो बैंक लॉन्च करेंगे, हमारा ये विश्वास है कि बैंक खुद उसमें क्या क्या रिस्क हो सकता है उसके मद्देनजर वो अपने फैसला लेंगे।
धन्यवाद सर। अब मैं जी बिजनेस के श्री ब्रिजेश कुमार जी को आमंत्रित करूंगा।
सर, आपने स्टेटमेंट में अपने कहा कि जो टॉप अप लोन्स हैं, एक तरह से बैंकों को उन पर ज़्यादा वॉचफुल होना चाहिए क्योंकि एंड यूज का पता नहीं है। तो क्या आपका इशारा इस तरफ है कि शायद वो स्पेकुलेटिव एक्टिविटी में जा रहे हैं या अनप्रोडक्टिव सेक्टर में जा रहे हैं? और इसी में ये मैं समझना चाहूँगा कि ये एक तरह से आपकी तरफ से इंडिकेशन है या कोई रेगुलेटरी या गाइडलाइन टाइप की भी चीज़ें आप लाएंगे इस पर? और अगर वक्त है तो एक सवाल और सर,
एक
सर्विस
सवाल
चार्जेस का रिव्यू आपने 2015 में मास्टर सर्कुलर आया था, उसके बाद से उसको रिव्यू करने का कोई
कौन सा सर्कुलर?
सर्विस चार्जेस।
नहीं नहीं, मैं एक क्वेश्चन लूंगा। वो फर्स्ट क्वेश्चन जो था, आपका समय नहीं है, बाकी लोगों का भी मैं बायलैटरली आपको अलग से बता दूंगा। और फर्स्ट क्वेश्चन था अबाउट
टॉप अप लोन।
टॉप अप लोन। मैंने स्टेटमेंट में ये कहा कि कुछ बैंकिंग एंटिटीज में ये नजर में आया है. इनफैक्ट आप अगर मेरा हमारा स्टेटमेंट जो अपलोडेड है वेबसाइट में, मेरा जो स्टेटमेंट है उसका वर्जन तो अपलोड हो गया है अभी वेबसाइट, आप आरबीआई वेबसाइट में देखिए, उसको मैंने दोहराया. वो सेंटेंस मैंने कहा कि इन सर्टेन एंटिटीज, कुछ एंटिटीज में ये हम देख रहे हैं कि जो रेगुलेटरी रिक्वायरमेंट है टॉप अप लोन्स के बारे में, उसको वो फॉलो नहीं कर रहे हैं कुछ एंटिटीज में. और मैंने दोहराया बाय सेइंग दैट आई रिपीट इन ए फ्यू एंटिटीज, मतलब उसको मैंने दोहराया. तो ये सिस्टम लेवल का प्रॉब्लम नहीं है, कुछ एंटिटीज में ये प्रॉब्लम्स आया है, उसको हम सुपरवाइजरी लेवल में बायलैटरली उन एंटिटीज के साथ डील कर रहे हैं, बट ये कोई सिस्टमिक प्रॉब्लम नहीं है. तो क्योंकि हमने कुछ एंटिटी में इस टाइप का एक ट्रेंड देखा, इसीलिए हमने सबको एक मैसेज दे दिया कि आप भी इस तरफ ध्यान दीजिए, क्योंकि बैंक का लोन्स तो कई ब्रांचेस, मतलब इतने सारे कंट्री वाइड ब्रांचेस रहते हैं, तो इसीलिए ये एक इशारा है, ये एक एडवाइस है बैंकों को कि आप इसको प्रोएक्टिवली मॉनिटरिंग करिए. मतलब उसका क्या एंड यूज क्या हो रहा है, एंड यूज मॉनिटरिंग करिए, और उसमें आपका जो प्रूडेंशियल नॉर्म्स जो रिक्वायर रेगुलेशन है, उसको आपके डाउन द लाइन लोग फॉलो कर रहे हैं या नहीं. ये एक उनको एक मतलब एक मतलब क्या कहते हैं, एक एडवाइजरी नेचर के तहत हमने बताया. और जहां जहां ये हमने नोटिस किया, जो कि कुछ एंटिटीज में है, वहां हम अलग से डील कर रहे हैं.
धन्यवाद सर. नेक्स्ट आई रिक्वेस्ट मिस्टर मनोजीत साहा फ्रॉम बिजनेस स्टैंडर्ड.
Good afternoon, sir. In your statement, you have said that the disinflation process is uneven due to large and persistent supply shocks, mainly due to food items. Are you happy with the way the government agencies are monitoring the supply side management? Do you expect them to improve their supply side management so that so that inflation, the disinflation process becomes more smooth towards the target?
You see, on the aspect of supply side measures, there is constant engagement between the RBI and the relevant ministries of government of India. And government has been taking number of measures. In fact, one or two, I think last year in the annual report, we have given out the list of measures which have been taken by the government to deal with the supply side issues in inflation, including food inflation. There's a long list which is given out in our RBI's annual report. And the various ministries are attending to the situation as it is emerging. Surprises are there, sudden rainfall and floods, etc. Even that is being discussed between the RBI and the government, and government has been taking steps.
So you are okay with the supply side management that way the government?
No, you are asking me to give a rating of government action, which I will not, because it's a continuing process of interaction between government. Government has taken number of measures, and that's how it goes.
Can I add one more on LCR?
Because please, I think somebody else can pick up your question, because otherwise LCR we have not yet introduced, not yet implemented. It's still in discussion. It's still in draft stage. So when the comments come, we will examine.
No, the question is why this additional 5%? Is there any sign or signal which you have found that that Silicon Valley kind of issues could happen? Was there a concern because additional 5%?
No, I think you have said that. Please, I think I was unfair to him that way by not allowing the second question. I would request once again, urge everyone, second questions you can clarify bilaterally after the press conference. But since you have said it on, in front of camera, I would request Deputy Governor Rajeshwar Rao to deal with that question briefly.
Thank you, Governor. I think Governor has rightly indicated it is a draft circular at this stage. And the LCR guidelines were issued in 2014. So that it was a time for a review which was warranted at that point, and taking into account the current developments in technology, digitalization, etc. So all those have been factored in, and the draft guidelines have been put in public domain. So we will wait for the public comments and then take a final call on what needs to be done.
Thank you.
Thank you, sir. Sir, with your kind permission, few more questions. Next, we'll have Mr. Ashish Agashe from PTI.
Thank you so much, sir. So you spoke about the global outage and how we dealt with it. Also, sir, recently, due to over-reliance on a single entity, we saw quite a lot of smaller domestic lenders, customers finding it difficult to transact, doing simple payment-linked sort of transactions. What really happens, sir? How can we avoid this? How are you looking at this?
I think Deputy Governor Swaminathan can take that question.
That's right. It was an impact was felt from an IT service provider because there was one of the third-party service provider systems were impacted, and incidentally, the entity was also providing the similar third-party services to many other smaller banks and RRBs. Since there was a likelihood of the risk transmitting to the other systems, as a proactive measure, they had to be shut off from the payment system. That was done as a proactive measure by NPCI, and it lasted for about 3-4 days. Apart from their own internal root cause analysis, there was an external party study was also conducted. Certain remediation measures have been recommended. They are being implemented. These are kind of instances is why we repeatedly insist on proper disaster recovery and business continuity plans, which has been reiterated even in this speech as well, that all service providers have got to have their DRBCP things robust, and also the banks have to have alternate avenues through which they can function. So these are kind of things that keep evolving, but we watch and then provide advisory. The Seaside has already issued its advisory as this event played out as to how banks can augment their systems and have their business continuity plans in place. We'll keep assisting the entities in terms of ensuring that the customer inconvenience is minimized.
You see, I would just like to small supplement. You see, the NPCI action to block further transactions wherever this particular service provider had been engaged was to isolate the problem. And if it had not been done, could have, I'm not saying it would have, it could have produced a system-wide impact, which could have been far more costly. So therefore, that problem had to be isolated and dealt with. And as Deputy Governor is saying, that the Seaside team of RBI has already gone into the details of it, and appropriate action has been taken.
Thank you, sirs. Next, we can have Mr. Laltendu Mishra from The Hindu.
Good afternoon, Governor. Taking Anup's question ahead, what is your view about the suggestion that by the economic survey that the food price inflation should be delinked from the framework?
No, I don't have any personal view. These are all institutional views. And as I said, the NSO survey is on. And based on that, if required, depending on the what the data throws up, depending on that, a decision will be taken at the appropriate time between the government and the Reserve Bank. But it all depends on what data and what picture the NSO survey throws up.
Thank you, sir. We'll have Ms. Hamsini Karthak from Money Control.
Hi, good afternoon. My question is pertaining to unsecured loans. The expectation is that in FY26, there might be a little more tightening of the regulatory framework as far as project loans related issues concerned, and on LCR as well. In this background, would you consider relooking risk weights on unsecured loans and lending to NBFCs, primarily because the circular which was intended to sort of curb these loans issued in November last year is beginning to somewhere do its job? So would you want to wait it out for another 1 year or so, see how much of it is percolating in the system and review it? Any guidance you can provide on that, sir?
I think you can take that question.
See, the November 23 measures are having its intended impact. We are watching the incoming data, but it is too premature to say at this point in time. It's only 2-3 quarter data that has come in so far. So we will watch out and then see how it progresses, number one. Number two, the growth has moderated, but still keeping good pace. from about 30% year-on-year growth in some of these segments that we saw when we implemented this. Currently, it's running at 15-16% year-on-year, which I think is keeping in trend with overall credit growth. So I don't think that a moderation or a revision of this is necessary at this point in time, but we will keep watching the incoming data. Coming to the second issue, in terms of rest of the items being tightened, I think they're all at the draft guideline stage at this point in time. And once the feedback is all collated, risk weights can be examined at that point in time and not now. Third, of course, is that on personal segment, what you would appreciate is that we only brought back what was the pre-COVID level. We are not actually enhanced. In COVID times, the risk weight on personal segment, certain categories were reduced to help difficult situation. So what we did in November 23 was only to bring it back to the old level. So it's not something which got enhanced, which will require a revision at this point in time. But we take your suggestion, but we will keep watching the incoming data and take steps as may be necessary.
Thank you, sir.
Thank you, sir. Next, we'll have Mr. Shyan Ghosh from the Mint. Yes.
Governor, you recently spoke about mule accounts in the system. Could you give us some insights on where these are originating from, what kind of accounts these are, and if you also could give some numbers on how many have been found in the system in terms of these mule accounts, some more data on that.
No, we don't have any ready data available for this. Do you have any this thing?
No, we don't keep that in terms of numbers. Essentially, what we do is that reiterating on advisory in terms of the KYC process, customer onboarding process, the transaction monitoring process, proactive risk management measure. These are kind of things that we'll keep insisting with the regulated entities so that the possibility of such accounts existing or being made use of by the fraudsters is minimized. That's what we will do. The number of entries, etc., and then disabling them is part of a continuous process. We work closely with the law enforcement agencies and the ministry and the participating banks to ensure that these risks emanating from this are minimized from time to time.
You see, banks have their transaction monitoring system. There are very odd, idiosyncratic transactions. For example, a low value, a bank account where the transactions have been of very low value. Suddenly, if the transaction frequency or the amounts being transacted, it goes up. In many such instances, the transactions are held at in late night hours. So the banks have systems now to monitor that, and that is something we have sensitized the banks. Most of the banks have systems in place to monitor such the behavior of this kind of accounts, to such behavior in the banking system, and wherever required, action is being taken. And as he said, there's a constant dialogue between there's a constant engagement between the RBI, the law enforcement agencies, the concerned ministries of government, and of course the banks.
Thank you, sirs. Next, we'll have Mr. Vishwanath Nair from NDTV Profit.
Governor, 2 times now in public speeches, you've talked about the retail deposit growth at banks and warning them that there could be structural issues in case this problem becomes bigger than it is right now. Either they're unable to or not willing to really take that extra step to attract more retail deposits. But is there anything beyond advisories and warnings that the RBI can do in this situation? Can you at any point in time push banks to actually start thinking about how to attract that deposits? Specific instructions.
No, this is again, this is for the banks to take their own decision. I mean, we trust the judgment and the risk management systems in the banks. As I said, that the risk management systems in banks have become much more robust today. So we don't want to do micromanagement for the banks. But yes, at the supervisors level, there are constant, discussions between our supervisors do interact with the banks at regular intervals. At my level, I have meetings with the CEOs of both public and private sector banks. Such issues come up for discussion. In fact, in the last meeting, which we had about a month or so ago, this was one of the listed subjects. We have discussed, shared our thoughts, and it's for the banks to really take the required measures. We watch all incoming data. I'm not saying with reference to the liquidity management. We watch all incoming data. from the banking sector wherever required. The RBI, wherever required, I'm not saying it, we are going to take some action tomorrow. As and when required, and when required, the RBI may take action. And please note that I am not saying that you should not conclude that RBI is going to issue a circular on the liquidity management. But all bank incoming data with regard to banking sector are monitored, and we sort of deal with such problems should they arise.
Thank you, sir. Last few questions, sir, or maybe last two questions, sir. Yeah. So we'll have Ms. Shama Mishra from Doordarshan.
Thank you, sir. So, what impact do you see of the flood situations in various states on inflation? Can the situation be worrisome going further?
No, we are monitoring that. It was sort of confined to 2-3 places. Kerala also, it was one particular district. Himachal also, certain regions of Himachal, and obviously the impact on the what impact they'll have on prices of vegetables or supply disruptions. We are monitoring them, and some of these things, the impact would be temporary. The impact would be temporary, and so it is constantly monitored what impact it will have on inflation on a wider scale. That has to be monitored, that we are monitoring, and that's it. I would like to say, but I would like to also mention, which is there in my statement, is that the monsoon now, I think, according to the latest number which we have, it's about 106% above the long period average, isn't it? 7% now. 7%, because it comes every 2 days or so. So 7% above the 7%, no? 7% above the long period average. And the Kharif sowing has picked up. So what it will achieve, and also there is a forecast of, lest you miss out, there's a forecast of La Nina playing out in the second half of the monsoon season. And the reservoir levels are also very, very good now. So what this will do is that it will have good impact on the Kharif output. So Kharif net sown area has also exceeded, and so we expect this to have a positive impact on the Kharif output. And because of the improvement in the moisture content in the soil, it will have a positive bearing on the Rabi output also. So these are things which we keep on monitoring, and we'll deal with it.
Thank you, sir. Lastly, I'll request Mr. Roysuke Hanada from Nikkei for his question.
Hi, good afternoon. I would like to ask about the government bond. At the end of the last month, RBI announced a new rule for foreign investors to purchase some government bonds. To be more specific, I mean to ask about the exclusion against the 40-year and 30-year government bond under the fully accessible route. And could you tell us the purpose and context of the decision, and what do you think of the potential impact of global investors' sentiment and the inflation preference for the Indian market?
I think that question was elaborately answered by the Deputy Governor Michael Patra. But so far as global investor sentiment is concerned, I think global investor sentiment vis-a-vis India continues to be very high. And I have given the data with regard to the FPI inflows, with regard to the FDI inflows. It is there in my statement. So I would, our assessment is that the global investors' confidence is very, is very, very positive so far as India is concerned, as reflected from the FPI, FDI flows. And also the fact that, so far as GDP growth is concerned, I mean, think the GDP growth of India is expected to be one of the is expected to be the highest among the major economies. And even the international agencies like IMF have also revised their growth projection for India upwards from 6%, 6.8 to 7%. So I think overall international confidence on India remains intact.
Thank you, sir. With this, we come to the close of this press conference. Thank.
Last question, sir, please. I haven't had a chance to ask.
Right.
Sir, no, good afternoon. Dr. Patra just said
No,
that.
just introduce yourself so that everybody knows. Yeah.
I'm Pratigya from Informist Media. Dr. Patra just said that liquidity conditions reflect the RBI's monetary policy stance. In the last couple of months, we've seen liquidity conditions swing so that overnight rates are down by 25 basis points. So, how do we read the RBI's liquidity management in conjunction with the current stance, which has been unchanged all this while? And are the RBI's OMO sales also aimed at draining core liquidity?
So, if you recall, some time ago, there was a peculiar liquidity situation where government balances were being built up and spending was not happening and liquidity had tightened. Now we see a much better balance in liquidity conditions. So we are doing, as in cricketing parlance, they say, we are middling the rate, the call rate. It's in the center of the corridor. And that's where we like it to be ordinarily. All our actions are intended to continue maintaining that. As I mentioned, that the call rate is our operating target. It reflects the monetary policy stance, and the stance is one of continuing to withdraw accommodation.
Thank you, sir. So we'll close this press conference with your kind permission. Thank you all for making it interactive. I thank the top management of the Reserve Bank for answering all the questions. Thank you all and have a pleasant day.
Thank you. Thank you all.
You can listen to The Front on your smart speaker every morning. To hear the latest episode, just say, play the news from The Australian.
From The Australian, here's what's on the front. I'm Claire Harvey. It's Wednesday, August 7. White-hot tensions in the Middle East, with the United States rushing military assets to the region in anticipation of a war between Iran and Israel. That story is moving fast. Check out the very latest right now at theaustralian.com.au. Senator Linda Reynolds says the late Labor Senator Kimberley Kitching told her Labor was going to weaponise Brittany Higgins' rape allegations against her. That's the latest bombshell in the defamation trial, where Reynolds is suing Higgins and her husband, David Shiraz. For mortgage holders, no rate cut this time. The RBA's kept the cash rate at 4.35% and ruled out a cut for the next 6 months. It's a welcome bit of certainty after days of chaos on global markets. So, what is going on with the share market? And what's it all going to mean for us superannuation balances? That's today on The Front. The stock markets have an unsettling habit of, about once a decade, going into complete meltdown, prompting the rest of society to have to start paying attention to what it is they actually do in their pinstripe shirts and expensive watches.
From the Independent News, this is USA Tonight.
Today is Black Monday, the day the Dow dropped more than 500 points. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute.
The cliche goes something like this. On a Monday morning, a bunch of 24-year-old stockbrokers go into work. They've had a big weekend partying and they've all got headaches. They've got themselves whipped up into a panic about something that happened over the weekend in international stock markets or the currency trade. And they get on their phones and start shouting sell at one another. The mood becomes grim. People lose money.
Bloodbath. It's panic. Everyone's in panic.
Well, this week, it's all happening again. On Monday, the Australian Stock Exchange's top 200 index was down 3.7%, the worst session since May 2020, when the panic was about the global pandemic.
I've been doing this for a while.
Eric Johnston is the Australian's associate editor. He's my go-to expert on business, banking and the economy. The last time I had him on the front, he was explaining why I shouldn't be in a rage about multi-billion-dollar bank profits. Eric is very zen. He doesn't tend to panic.
When I saw stock markets around the world starting to crash, you always think in the back of your mind, it will sort of bottom out at a fall of about 2%, 2.1% or so on. But to see the markets keep getting lower and lower, crossing a 3% threshold, that's a red line, certainly when you look at it as a financial journalist. Seeing shares in Japan crash by 12%, they're numbers that you just don't see. They're once in a lifetime type figures.
But every time this kind of market panic happens, I can't help myself. I go and check my super balance. I'm a bit worried about this because last time I did this, one of these things happened. I checked my super balance and it was way down. Eric, as soon as I heard about market chaos, the S&P falling, the NASDAQ in crisis, I immediately went and checked my super balance. Is that something you would recommend people do?
No, definitely not. Remember, your super is long-term. So that's for your career. You've got another 20 or 30 years worth of working, Claire. So the super is going to go up and down from day to day. So kind of meaningless in the bigger sense of that. Focus on the long-term trend.
It does make me worried, though, that a bunch of 27-year-old stock traders wearing pinstripe suits and shouting at each other are potentially going to wipe out all this money that I've been saving over the years in my super account.
Well, the first point I have to pull you up on, I'm not sure they wear pinstripe suits anymore.
I'm about 20 years out with my reference.
Yes. So they're all sitting at trading desks and behind screens, and it's actually big boxes in the back of Goldman Sachs or Citigroup or something actually doing the trading. Those traders don't exist. The broader point is, though, there are big global forces that often influence the value of our shares, that we sort of park away. These things rise and fall on global currents.
Okay, so this time, what caused the big panic?
So initially, Australia was reacting to quite a violent sell down in the US on Wall Street on Friday. What we're starting to see is what's called the unwinding of the carry trade. The carry trade is when you borrow money from a country where the interest rates are very low and reinvest that money somewhere else in the world where returns are much higher. So you might borrow money from Japan, which have near zero interest rates, and put those funds in, say, the United States or in Australia where interest rates are much higher. You get that return that represents your profit on that investment. That only works as long as interest rates in the borrowing country stays low and stable and markets remain stable as well.
Right now in Tokyo, it's a sweltering, humid late summer, 33 degrees. The locals are drinking ice-cold cans of milky soft drinks and listening to 24-karat Gold Genesis, the chart-topping single from a 16-member J-pop band called The Rampage from Exiled Tribe. And there's something else making everyone sweaty. The economy is going through a massive change. Interest rates are going up for the first time in nearly 20 years.
So what happened last week was the Japanese central bank, the Bank of Japan, increased its interest rates and suggested that there could be more increases to come. At the same time, you're seeing the prospect of interest rates in the United States coming down faster than expected. That's because of a fear that the economy there is slowing. So you're seeing this great arm wrestle, this great reallocation of money being sucked out of the US market, particularly that was in high yielding shares such as tech stocks. So you like your Nvidias, your Microsofts, your Amazons, and that's been reallocated back into Japan. Also with the Japanese shares falling so violently, you're seeing money sucked out of the Japanese share market, which has been bid up and moved into Japanese bonds. And what can you do when you sit there watching your Commonwealth Bank shares rise and fall? Not much. You just hang on for the ride.
Coming up, why interest rates here still aren't going down. It's always reassuring to talk to Eric, and you can read his soothing analysis every day by joining our subscribers at theaustralian.com.au. We'll be back after this break. It seems every time there is a big story about a big kind of global share market sell-off, that what it boils down to is some exotic new product that has been invented. You know, it's credit default swaps, or it's CDOs, or something that people are selling to each other that nobody else can understand. Is the carry trade another one of these exotic products, or is it something that is more significant, that's more serious?
This time, it really is different. We talk about in markets what we do know, what we don't know, and then what we really don't know. So this time it is different because we do know what the risks are out there. We've got the Chinese economy slowing, but we've known about that for some time. That's starting to play out on commodity prices. The US economy is slowing. What we don't know is the pace of it. Even here, we've just seen the Reserve Bank keep its cash rate on hold, although the statement was hawkish, which means that they are threatening further interest rate hikes. We kind of know that they're going to hold on until they watch inflation go down. There's nothing that seems to be lurking in the corners for markets this time. What we do know is the valuations of stocks, like your Commonwealth Bank shares, have been bid up incredibly. So Commonwealth Bank is trading at historic highs and is so overvalued. It's like when we previously walked into a shop and we're paying $10 for a lettuce. We all knew that was so overvalued. Anyway, most of us still bought it anyway. Commonwealth Bank shares a little bit like that, has been bid up to such an extent that it is overvalued. So that's why this pullback is different. It's not something that we're all sitting here white-knuckled and scared about. We know the risks in the world. We've been living with geopolitical risks for the last 2 years. We know inflation's out there. So the bad stuff is already out there.
You mentioned that so much trading now is automated. It's done by a big box sitting in the corner. Has that created a kind of different mood in the markets? Are they more mature now than they were when a whole bunch of people who'd done too much coke were frantically selling everything at the drop of a hat?
I don't know what the computers are doing, but but look, potentially the valuations and the calculations that go into buying and selling is much more sophisticated than what a desk jockey could ever figure out. So the instinct, will Commonwealth Bank hit its earnings targets this year based on what we know about the economy? Yes or no? A computer can figure that out much more accurately. But we are still talking about markets which are driven ultimately by emotion. You and I still walked into that supermarket and we still paid $10 for that lettuce because, hell, we wanted it and everyone else wanted it at the same time.
Cabbage is just not the same.
Just not the same. So, look, markets are driven by emotion still. However, there's more buying and selling. There's more turning over. It's easier to buy and sell shares compared to what it was when we're talking about back in the day of the pinstripe stockbrokers. You had to physically ring somebody up. You had to place an order. You had to have the money. Now you can just do it at a hit of a button. Big fund managers can just buy and sell and churn over their portfolios. Liquidity, people often think it's a bad thing, but it is actually a good thing because it helps markets discover prices much more efficiently.
On Tuesday afternoon in the office, I saw you poring over the statement from the Reserve Bank along with some of our other big brains in the business section. What is the Reserve Bank saying about the future of the economy, and what do you think about how we're going to fare over the next few months?
Yeah, this one, there was a lot of scrutiny coming into this Reserve Bank meeting because there was talk just a few weeks ago, real serious talk among economists, that the Reserve Bank could, in fact, be forced to raise interest rates yet again. And that would be a really hard shock to a lot of people paying mortgages. The Reserve is concerned that there is still quite a lot of spending in the economy, but it's in different areas. And it might not be those people that have just bought into a house or a mortgage. We know that those people are doing it tough, particularly in the late 20s and early 30s. They're the cohort that are really feeling the squeeze. They've just got a house. Maybe they've got a young family as well. So money is just going out the door like nothing else. There's a category of consumers in Australia, net savers. Those people have never seen it better before, and they're spending as well. Another factor is, and despite what we hear, unemployment is still quite low in the economy. If you're starting a business or if you're still trying to hire, it's maybe eased up a little bit, but it's very hard to get labour. to get workers in the door. So the RBI is still concerned, like the economy is still sort of maybe a little bit too overheated, and that's why they're talking about potential further rate hikes.
Eric Johnston is an associate editor with The Australian. $16,000 US Marines should be deployed to Australia every year to help us defend ourselves. That's according to a report revealed in The Australian today. Check it out at theaustralian.com.au.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are coming to you live, as always, from the CNBC TV18 Motilal Oswal studios. And I think today will be the day when we say that the Nifty's crossed past 25,000 in a clean, nice way. Not this much left, but 30 points left, 20 points left. 3 days now, the market's been biding time ahead of the Fed event. That's done now. And as the GIFT Nifty is indicating, it's going to be a good start. I'm Prashant. With me, my colleagues Nigel and Surabhi is with us today. Guys, hi, morning.
Hi, good morning, guys. I like your confidence. I mean, don't want to spoil the party. Asia is down, but yeah.
You know, I remember on closing, it was the day before yesterday, you guys were taking bets. I'll take a bet today. It's much more certain.
It's a safer bet, right? He's playing the odds well.
Well, and we've got plenty of cues, right? The Fed didn't disappoint overnight. You've got plenty of result reactions, and then you've got that tax notice on Infosys. So we've got an action-packed day ahead, and it's Nifty weekly expiry as well. So Prashant, let's kick start.
Oh, absolutely. And definition of hands full.
Absolutely.
And how. Well, let's just quickly sort of rewind the clock back and take you to what the Fed did, because I think that's the big mover this morning for Asia, for India, for, so much else as well. So you had the Fed Chair Powell now basically confirming the Fed is closer to rate cuts if data cooperates. That's point number one. Essentially, the gist of all of it, the press conference, the statement, the Q&A, everything is essentially that they're closer now. And the important thing is that all of the commentary essentially suggests that the bar for a September cut is not very high. They're not fixated on one point, on the data being this or that. It's a process, as Chair Powell in the Q&A sort of addressed many times. The market's base case as a result has moved to a 25 basis point cut in September. That's the base case which the market is building in. But if you look at what the market pricing is indicating, last night after the Fed meeting and everything, it moved up to 30 basis points for September. So that is, essentially that suggests that maybe it's, some are saying 50. Could it be 50? Well, let's not go that far. 25 is the base case. And the market's now kind of very anchored towards the fact that we will get 25 in September. Remember, they're still data dependent. And in that sense, the job market data tomorrow, Friday, is going to be important. The monthly number, the NFP, which we get. US equities responded. So NASDAQ was up 2.6%. There were earnings to boot as well. I'll get to that in just a bit. But the S&P was up about 1.5%. Yields across the board, the 5, 10, 30, everything came off very sharply between 11 and 15 basis points. The 10-year on the US was down 11 to 4, just about 4% now. So, it could be 3 point something from 4.5, 4.6, not very far away. That's a big change. And of course, the dollar index is below the 104 levels, around the 104 levels as well. So dollar is also weaker. Now, after the New York close, you had Meta, which reported earnings, and the earnings beat expectations. It's one of the so-called Magnificent Seven, and the market is watching the signaling impact from this very closely. Remember, so far what we had from Microsoft and early last week has not been all that great, Google, etc. But Meta beat. There was also Qualcomm, which gave a bullish forecast. And I think this is adding to optimism that maybe what we saw overnight will continue this morning and into US later as well. Oil prices, they'd sort of fallen one way, 8% or so till day before yesterday over the last 1 month. But there was this geopolitical premium, especially in the Middle East. So there was a 3% pop. I think we're back above 80-ish, $80.5 a barrel. the impact, the implication from a Fed cut. I mean, it's not as if Fed hikes have hurt markets, global markets. Fed has hiked interest rates by 500 basis points, but the US market is at a record high, the Indian market is at a record high, and global markets have done very well. But for emerging market perspective, what matters from a Fed perspective is essentially flows, foreign flows, which have been hard to come by lately. Last 3 days, FIs have been sellers, and the market has struggled. And the sort of idea is, if that starts to turn, you essentially get one more support apart from domestic liquidity. So circling back to specific levels on the way up, as I've said, the resistance for the Nifty essentially is 25,000 to 25,337. Focus on the upper end of that band. That's the extension level, 25,340 or so. Supports come in at the 40 hourly average, which is 24,780 is the nearest support. And of course, 24,530 is the 20-day moving average. Bank Nifty needs to take out the recent high, which was 52,340. We're very close to that level. And on the way down, Monday's low, this week, Monday's low of 51,186 will be an important level, which the Bank Nifty must sort of defend if there is any selling, any hesitation which starts to appear. And I'll just leave you with the GIFT Nifty, which I think is indicating that 25,000 par level with 60-65 point gap up this morning. Surabhi.
All right, Prashant, absolutely. So I guess the biggest positive cues coming from the Fed, right? Yeah. But we do have headwinds around our neighborhood and here back at home. So I have to put that on the table as well. For the Fed, I just thought we'll put out the line from the statement and also Mr. Powell's press conference, because very rarely do you have any Fed chief coming out and actually giving a month as to when the cuts will happen. So just for reference, the statement is up. So the FOMC statement said that in recent months, there has been some further progress towards the committee's 2% inflation objective. That was the wording in the statement. But in the press conferences, when the market got the real kicker, because that's where Mr. Powell himself said that if that test is met, meaning if data continues to suggest that inflation is going down, if that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. Not usual to get a specific timing, a specific month from any Fed chief, but that's what we got, and the market was rejoicing. The US yields, by the way, in the tumble overnight, they've gone back to levels last seen in February. In February, early Feb, is when the US 10-year had started its upward trajectory, crossing 4%. The other, of course, headwind is oil. Brent is closer to 81 again, given everything that's happening. It's almost like it's out of a movie, but it's not a movie, it's reality, with the killing of this Hamas leader, that too in Tehran. So lots of geopolitics at play over there. So let's watch for that. The other global headwind is actually coming in from the way Asian markets are reacting. There's no sweeping rally across Asia. The Japanese market is down 3%. That's at the headline index level, the Nikkei. The Topix is down almost 4%. So that market's sort of reeling under its own issues, with the Bank of Japan cut coming in yesterday. The yen has crossed 150 to the dollar. Huge weakness in the Japanese currency. So those are some of the Asian cues to keep on board. A lot of regional markets like Hong Kong, even Singapore, they're all down. For us, talking about the fund flows, Prashant mentioned that FIIs have been net sellers for a while. That continued yesterday. Sold off stocks worth about 3,500 crores in the market. Good news, as usual, is that domestic institutions are buying. Their buying was almost offsetting the FII selling at 3,300 odd crores. Results, of course, our team is going to tell you more, but it's been a sort of a mixed picture after market hours. Just to give you a flavor, Nigel tells us that Tata Steel was more or less in line. Bank of Baroda has been a bit of a mixed bag. The asset quality is improved because they've sold off a lot of bad loans. The margins, however, are under pressure. So let's see how the street reacts to that. And you've got some strong earnings. GE, TND would be the one I'd watch for. Very, very strong top-down beat coming in over there. It's a very heavy results day today as well. The names are on your screen. ITC, Tata Motors, Sun Pharma. Lots of interesting large mid-caps like Thermax, Imami, as well as Zomato. So we have our hands full. And as if we needed more, there's the big Infosys news to react to as well. So the news is that the company has received notices from two separate entities. At the state level, it's the Karnataka State GST Authority, and at the central level, it is the Director General of GST Intelligence. The demand is 32,403 crores. The company is outright denying it, saying that it's already met all its obligations. We'll talk about that in more detail in just a bit. But this maybe is going to be a bit of a dampener on that stock, at least for the day. Let's see if it has a ripple effect across the sector, but it's a big one, and that's a big number. So it's something that can't be ignored.
Well, that's right. The positive overnight cue is that's what's going to help the Nifty get to around the 25,000 odd mark. But the question is, can we stay above that level, that 25,000 odd mark? So we'll know later on in the trading session. The second point is Infosys, that big tax notice has come in there. but will the markets choose to look through that and in fact buy the dip? And from a market perspective, I think that dip could get bought into. So let's see how that goes, because that's going to be a bit of a drag in today's trading session. Just to start off first. By the way, today is the start of August, and historically, August has been quite a good month. We look at the last 5 August. Well, it's been more green than red, though the last one was a bit of a downer. So August normally throws up a 2.5% to 3% move. Let's see which side we go for this time around. Global cues are positive, as I said. 2 indicators. One is the dollar index is weaker, and the yield as well. The US 10-year yield was softer because of the more dovish than hawkish cues coming in from the Fed. Let's focus on Infosys then. And Infosys is going to be a large weight that's going to be lower. It's part of the top 5 weighted stocks on the Nifty itself. So, you'll have to see some kind of support coming in from the others, or Infosys itself will have to see some bit of recovery from the lows of the day. Infosys, the weightage on the Nifty is close to around 6.1% or thereabouts. So they'll be keeping an eye on the others as well. ITC comes out with its set of numbers, but Infosys 6% will start off a little bit low. So let's see what kind of buying we see on that one. Positioning on index futures, the FIs, they remain net long. Clients remain net short with close to around 60,000 contracts on the short side. It hasn't moved much. That's why I haven't given you the change overnight. What about the options data? Today's weekly expiry and 2 strikes were fairly active, the 25,050 call and the 24,900 put. So just plugging in those premiums out there, you'll get the broad range. On the upside, 25,050. I've been saying this from the start of the week, that's a bit of a resistance level. And because of the options data, that's the vicinity that we're looking at. On the downside, support comes in at around the 24,800. For today, the 24,850 mark becomes rather important. The Nifty Bank, that's going to be the mover for broader direction and, from here on, because it's pat in the middle of the 20 and the 50 DMA. Which side it moves, which side it breaks to, that's going to be important. For the time being, it's pat in the middle out there. The 20 DMA a little bit away, while support is at the 50 DMA. The stock I'm looking at is Tata Steel. The numbers were actually showed a bit of an improvement. The problem is that, they're waiting for a Supreme Court verdict with regard to whether or not the states can go ahead and levy taxes retrospectively. So that's going to be important, and that could weigh on the stock. So though the numbers are important, I think the street takes note of the debt in the books as well as the crucial verdict that's awaited. So that could be a stock of the day.
You never get away from taxes, right? Company level, personal level, taxes are a reality, and they, hold the key to our happiness or unhappiness, whichever way it might be. Let's move on. Get to some money market views for the morning. We have Parul Mittal Sinha of Standard Chartered Bank, who says that the USD INR continues to trade in a narrow range, with local banks accumulating FX reserves at a consistent pace in the 83.40 to 83.60 range. She says local banks absorbed all the month-end FPI flows, while oil import demand led to a gradual rupee depreciation. She continues to expect the pair to trade in a range of 83.55 to 83.90 in the week ahead.
Well, she also weighs in on the bond market. She says that India rates moved lower as draft LCR guidelines released by the RBI has led to expectations of incremental bond buying by the bank. She says RBI has also released circular notifying new 14-year and 30-year bonds as non-fully accessible route securities, that is non-FAR securities, thus limiting the FPI participation in future 14 and 30-year bond issuances, which led to steepening of the bond yield curve. 10-year yield this week is going to take cues from global rates and expected to trade between 6.85 and 7% in the near term. All right, well, let's just get you some global perspective now. Robert Sokin is with us. He's global economist at Citi. Robert, great to have you with us here. Thank you very much for your time. So what has the Fed meet done for markets incrementally? Has it raised confidence that we will get that 25 basis point cut in September? And not just that, that this is perhaps going to be the beginning of a rate cutting cycle? Is there greater confidence after what we heard from Fed Chair last night?
Absolutely. And thanks so much for having me. I think what's always important with these Fed meetings is you get a lot of information about how the Fed is viewing the economy and how the Fed is viewing market pricing. And what we heard from Chair Powell, in my view, is that he and the rest of the committee are really setting the stage to cut in September. And I would be very surprised, given his tone today and the improvement that we've seen so far on inflation, if they were not to cut rates once we get to that meeting. So I think that was one very important takeaway. I think another important takeaway is that Powell emphasized that they are focusing on both sides of their mandate. They've seen enough progress on the inflation front to feel that they're getting close to being able to ease policy, but they're also starting to get a little bit concerned about some of the softening they've seen in some of the indicators on the activity and labor market side. The economy has held up well, but the risks of a slowdown, I think, have risen as rates have been higher. So I think that's the other important takeaway, which, putting both of those together, I think really does pave the way for the start of an easing cycle once you get to September. Now, it's going to depend on how resilient the economy is and how much inflation improves from here. But I think you're going to get one cut in September and then maybe one or two more cuts this year. And then next year is going to depend on how resilient the economy is and the inflation developments.
Okay. Robert, hi, good morning. So typically when the Fed cuts, everybody parties, right? Now the party's been on for a while in anticipation of this September cut. So what's your sense? And the bond market is rejoicing. We saw the 10-year yield fall to about 4%. Stocks are anyway rallying. Even gold has been moving higher for other reasons as well. So what's the sense? If the cuts start coming in now, then are we looking at elevated asset price levels?
Yeah, I think for these other assets as well, it's going to depend on how resilient the economy is. So in some sense, it's going to depend on why the Fed is cutting rates. Right now, I think what you're seeing priced into markets and what the broader consensus is that we are getting some type of a soft landing scenario. Now, as I mentioned, there are some risks that the economy could slow down more, but broadly speaking, the economy has held up well and inflation has continued to improve. So I think that is a very positive environment for equities. And I think you're seeing that priced into markets. So if the Fed enters a cutting cycle and the economy is resilient, that's kind of the best of both worlds for risk. Now, if the Fed starts to cut and the economy slows down more and they have to cut because a recession is ensuing, that's a very different outcome. To me right now, the data are feeling more like a soft landing. Our house-based case is that you will get a sharper slowdown in activity. But I think most market participants, I think we're seeing price in the markets, is more of that soft landing flavor, which would be very positive, as noted, for risk.
Hi, Robert. Morning, and thanks for joining in. Well, you've told us in the past that from the equity markets, India stands out, and that was the preference out there as well. I wanted your reading on what the Bank of Japan did. They've slowed their bond buying program, and also they went ahead and they cut rates. Implications of this, for the time being, the Nikkei is down closer on 3% odd. That was showing signs of coming back. I think it returned to those levels we saw, say, 30, 40 years ago or so. But view on that market as well as implications.
Yeah, absolutely. And, this was a difficult central bank to call because what you have seen in Japan is you've seen inflation pressures hold up or pick up relative, of course, to where they were pre-pandemic. So, there has been hope that Japan will be able to sustainably hit its inflation target. At the same time, the currency in Japan was feeling enormous pressure, and at times you saw very weak currency levels. And so the question became, was Japanese policy going to respond to the weakness in the currency, or were they going to keep rates relatively low for longer to kind of help ensure that they end up hitting that 2% inflation target? And I think what you ended up seeing was that the Bank of Japan was concerned about some of these currency pressures and felt, given how high the Fed has been throughout this year, that it was time to start raising rates as well. Now, if the Fed had cut rates earlier this year, that would have taken pressure off the Bank of Japan to raise rates because I think the currency won't be as weak as it has been. So I think you're seeing the Bank of Japan not only respond to what's been going on in its own economy, but what's been happening with Fed policy as well. And I think more rate hikes are coming from Japan, given what we've seen come out